Thank you for joining in another episode of the Dealmaker Series. Today, I'm joined by Michael Becker. He is principal at SPI Advisory. Michael, thank you for joining us today. Tell us about yourself and tell us about the firm.
Hey, James, thanks for having me on. So, yeah, Michael Becker. I'm based in Dallas, Texas, and run SPI Advisory. So, we are Dallas multifamily investment platform. We focus on Texas, or three of the four majors in Texas. We own Dallas, Austin, and San Antonio. We've done about 20,000 multifamily units in the last 12, 13 years. We own about 8,500 today, mainly kind of class 8, A minus, so kind of like 20 years or younger from a vintage standpoint. It's the majority of what we own, and appreciate you having me on today.
Excellent. Excellent. I was kind of doing a little bit of research, and it looks like you guys are somewhere north of about $1 billion in assets, mostly here in DFW, or is it everywhere in the
Yeah,
state?
so about 2/3 are in Dallas Fort Worth, and about thirds in Central Texas. And I don't know if anything's worth anymore today, but yeah, certainly probably north of $1 billion. About 8,500 units. So it's been a really good run, and the last couple of years have been a little bit more challenging and unpredictable, and kind of working through that. So happy to talk through anything and everything multifamily, and how we do deals, and how we kind of navigate the realities of the market once you actually kind of own some of these deals too.
Yeah, for sure. Thank you for being on. And it's nice to have someone that's got properties actually here in the Metroplex that we might actually drive by or maybe live in. So very cool. So first question, what are you seeing in deal flow? What's the current state? Is it increasing or decreasing?
Yeah, it's choppy out there. So I mean, I think we're seeing, we focus on predominantly, 200 unit plus large multifamily projects in Texas, and generally on the nicer vintage. I started out my career some of the older, kind of 1970s, 1980s vintage deals, and so it's kind of a barbell approach here lately. You've seen a lot of distress in the marketplace. So up in Dallas Fort Worth, to be specific, you're seeing a little bit more distress within the older workforce housing stuff, and not as much on the nicer, newer stuff. You go to Austin, the entire market is pretty well distressed, just with the amount of new multifamily projects that they delivered. Kind of starting 20, I guess started in 21, kind of delivered through 24. They just dumped a tremendous amount of multifamily product on the ground all at the same time. So you're seeing more of the distress kind of being the top end of the market. So it's been kind of interesting. You see a lot of people that would love and need to sell, but not many people like the price. So trying to find a willing seller at today's prices has been kind of challenging. You're kind of seeing some of the lenders get involved, and now where there is no equity for the person that overpaid for a deal in 2021. So now either at the debt basis for the lender, or maybe below the debt basis, they need to take a short sale, or maybe a lender kind of foreclosed. And then there's a bunch of nuance, and a lot of these lenders are offering kind of accretive special financing to maybe try to get a better price. So a little bit of everything. But I think the short answer, that's a long-winded way of saying, I think we're starting to see the supply of new opportunities increase, albeit a little bit more slow and painful than I think we'd all want it to be. But you're starting to see kind of the log jam, starting to see a little bit of that kind of breaking right now.
Well, that nicely segments to my next question, which is around structure. So what sorts of deal structures are you seeing more frequently now?
I mean, deal structures meaning like how do we raise capital and things like that.
Yeah, how is that kind of shaking out? And you mentioned that lenders are starting to maybe get involved more.
Yeah, you're certainly seeing the workforce housing space in particular, say in Dallas Fort Worth, and I'm sure San Antonio as well. There's not much workforce housing in Austin. If it was with the buyer and a deal done at the peak in 21, 22 kind of time period, these people are underwater almost universally. And if you're selling today, you have to sell. It's not a want to sell in most scenarios. So you're seeing some of the lenders give accretive financing there on the nicer, newer stuff. You're generally not seeing that. It's just kind of you put your own loan on it. Fannie, Freddie still pretty active. 65, 70% loan to value, things like that. I mean, the capital is becoming more interesting. Back, on the workforce housing space 5, 6 years ago was all a lot of or virtually all that was kind of private capital, a lot of syndication style equity. Those guys are much more challenged today. It's kind of harder to raise syndicated capital. So you kind of see joint ventures, and then even those guys are all picky. And so it's been you got to kiss a lot of frogs to find your prince, I guess. And there's a lot of that out there as well. So so it's a challenging market to operate in. But I think if you can acquire today, I mean, is if you get a deal done today, I think you're going to look back at a few years and be pretty happy that you did. It's just not super easy. And those in a few years said, if I just would have bought everything in 2025 or 2026, it's a lot easier to say that than actually do it. It's a pretty, difficult environment. You're dodging landmines every time you turn around.
Yep. And so let's talk about assets and maybe submarkets. What are most active right now? Are you seeing?
I mean, I think, like I said, I'd say Dallas Fort Worth. I just kind of just talk about that. And this is where I live and know that better. I mean, the workforce housing space is kind of, tends to be a little bit more infill, kind of suburban infill locations. So not much like your northern suburbs like McKinney and Allen, and they just don't have much apartment stock. So you got your kind of your in-town stuff in Dallas and Fort Worth, and then Arlington and Grand Prairie and Garland and some markets like that have a ton of older workforce housing. So all that's got some level of activity kind of picking up just with it, and virtually all of it having some distress with it. On the newer, nicer stuff, a lot of the deals that are actually has been much less willing to actually go to market and trade, and those that are tend to be kind of your higher supply areas, like your Allens, your McKinneys. You're seeing some of those pockets, up the 380 corridor is they built 10 years ago there was virtually no apartments. Now there's a ton of apartments, and they're all having to compete against each other, and those are you're starting to see some of those kind of break loose and trade. I had lunch today with one of the top brokers in Dallas. We toured a deal and we had lunch, and he mentioned he's going to bring out a tower in downtown in a few months, so that kind of in uptown. That'd be the first kind of like core high rise. Hopefully it trades for him in probably 2 to 3 years. They really haven't seen that, so that'll be kind of the first kind of core high rise that's going to try to go to market in a while now.
It's very interesting, and I live in Uptown, so that's exciting to hear. And so you mentioned several different regions here in the Metroplex. I'm curious, are you seeing much opportunity or growth in the Fort Worth area or the Tarrant?
Yeah, I think this Fort Worth certainly has a lot going for it. We own a bunch of property in Fort Worth and have historically. So I think there's a lot of opportunity everywhere, right? So the growth tends to be there's some growth in the core, but really kind of up the 35 corridor towards Alliance tends to have a ton of growth in Fort Worth. We like that pocket quite a bit. We used to own there. We sold a deal a few years ago, but like the kind of the Alliance machine, economic development machine is kind of unstoppable with just all these big corporate relocations and big expansions, and they have in the Alliance corridor. So I think that's probably the most high growth part of Fort Worth in my estimation. But Fort Worth's also growing west. I mean, it's kind of a little bit of suburban sprawl going west. You don't have as much employment, but a lot of large subdivisions going to the west. And then kind of the south, you have some industrial. The Chisholm Trail has been a big thing that's opened up kind of the southwest part of Fort Worth. We own property down off the Chisholm Trail near 20. So you've seen some kind of growth down there. There's been a big, I think it's Tarleton State put a adjacent campus down there. Downtown Fort Worth, you have the Texas A&M Law Center. They opened up a big law center down in Fort Worth, which I believe is open or just about to open. So that should hopefully be a help to the core. So Fort Worth in general is growing quite a bit. We like Fort Worth, and it's just about being in today's environment. It's about finding the right value and who's willing to transact. So I think, given a few years, it's all going to look good. It's just a matter of what's your entry price.
Yep. I like that. And so thinking a little bit broader now, what economic forces are impacting deals right now?
So, people that own or you're buying, I mean, if you're in a newer, well, really, if you're newer or older, new supply that was delivered in the recent past is certainly putting pressure on the top of the market, and they're having to offer, concessions, free rent, 1 or 2 months free rent, maybe a little bit lower rental rate to attract residents. And then the residents go fill those up, then abandon the 20-year-old product, and then those are going to have to either lower the rents or offer concessions or both, and then that leads to the 40-year-old product and then older. So you're seeing kind of like it go down, filter down from the top of the property grades to lower property grades. The supply in Austin is particularly acute, where the workforce housing is in, it's not historically you wouldn't think a 50-year-old building would compete with a brand new building. It doesn't necessarily compete, but the residents just started trading up because the dollar is being stretched quite a bit more. So we're having to deal with that from a kind of a supply standpoint. But, the economy seemingly is holding up pretty well. I mean, compared to 18, 20 years ago when we were in the great, the GFC, I mean, not everyone, you kind of had everyone lose their jobs and you had property values go down. You had a bunch of things go bad all at once. Here it's really been a supply issue. And then unlike 20 years ago to today, rates were high and started falling. Now rates are kind of higher because everyone's worried about inflation. So, so those are kind of the main differences that I observed, 18, 20 years ago, kind of observing today. But I think for the most part, economy still held up pretty well. You feel, and I think our tenants and residents are kind of feeling the pressure of some of the inflation, the accumulated effects of the inflation since COVID, where everything just kind of just here and there, utilities and food and insurance and car payments and everything just kind of has been chipping away at their income, everything but rent. Rent's been going down and everything else has been kind of going up on them. So, selfishly, obviously, when rent turns around, that'd be certainly helpful for guys like myself. We'll see what kind of, what else gets affected when we start seeing rental rate growth again.
Are you seeing any impacts, would you say, from the policies around tariffs or anything like that? I know that would probably more primarily impact new development, but I'm curious if you're seeing any impact there.
Not like as much. I mean, you have some supplies, maintenance and repairs and things like that. I mean, I think that's a little bit more impactful on new development. So if you're trying to new construction is very difficult to make sense economically today, just with the overhang of the excessive supply they built in 21 through 24, let's call it, and then the pressure on rent. So if you did throw cost pressure and all your materials and everything else keep going up, it just doesn't make it easier to make a new start make sense. So you're seeing the new construction starts kind of fall down dramatically versus kind of recent years, and it's kind of starting to get back to where we were. And I think you're looking forward to like next year, we'll probably have a similar start number in 2027 that you did in probably 2012. And then if you think about Dallas-Fort Worth, probably has 2 to 2.5 million more people in the metropolitan area in 2027 than it did in 2012, in that 15-year period, and they'll have similar number of starts. So it's a matter of time before this kind of corrects itself and you see rents go back up. The question is, can you survive and own your properties long enough to get to that point, and what's your capital stack? And unfortunately, a lot of people that bought in 21 and 22 on 3-year bridge debt, they're not gonna make it to then.
It's good insight there. So last question, we can kind of look into the crystal ball a little bit here. What do you see coming next for the multifamily real estate industry?
Yeah. So, I mean, like I said, I think we're in the process of, in real time, of seeing a lot of these deals clear. So they're in a clear, it's kind of resetting everyone's market expectation of where things should trade at, like what cap rates and what kind of per door metrics everyone's looking at by vintage. So I think that's kind of certainly has happened. We've seen price discovery, and now I think it'll kind of follow through. I mean, all these older deals that were bought at the peak, they all just kind of need to clear before we start seeing real market recovery. So I'm hopeful that we kind of accelerate that just selfishly. Let's just kind of get it over with and get that done in the next, 12, 18 months. And then we're kind of on the road to recovery, along those ways. I think we're seeing more. See most of our buildings, we feel like we should be able to get to kind of stabilize occupancy coming out of the summer, the kind of mid 90s. I think once we kind of get to the mid 90s, I think we'll see rent growth kind of recover. I think Dallas is 9 months ahead of Austin. So I think rent growth kind of just around the corner in Dallas-Fort Worth. And at some point next year in Austin, we'll see the rent growth, albeit off a much lower base than where it was 3-4 years ago. And I think we're just kind of on the, kind of the onset of the recovery, essentially. We need to flush out their old deals, and there's just a bunch of zombie deals, essentially, at this point. I mean, they're dead. The body just hasn't fallen, from those deals. So we just need these deals to clear. The body will fall, using that analogy, and then we kind of are back to the road to recovery. I mean, there's a ton of interest in capital that want to be in Texas, that want to be in multifamily. They just want to make sure that they have attractive entry points, and then the larger institutions they never tend to be the first one. They want to make sure that they have seen it as proof of concept, and then they can then pile in and kind of make sure they don't lose their jobs and making a bad decision and being early. They tend to be a little bit late. So once you see the institutions come in and scale, yeah, I think it's pretty safe to say that we got a multiple year kind of recovery ahead of us. And I think you're starting to see those guys take some bets. It's just,
Yeah.
we need to see more of those.
Yeah, the one of the advisors I hosted on a panel recently put it to me this way, that the price of being wrong is very high right now. So
Yeah.
I think that's what I'm hearing there. But that's great, Michael. I appreciate these insights. That's a lot of insights. I really do appreciate your time around that. And those watching, I hope you can find as much insight out of this as I do. And for those that want to find more insights, you can find more episodes of the Dealmaker Series on my YouTube channel or on my LinkedIn. Michael Becker, thank you for your time, sir. Strategic Property Investment Advisory. You guys are doing a lot of good work. So thank you, sir.
Thanks, James. Appreciate it.